Hello, everyone. Welcome to this webinar on bookkeeping best practices. I'm your moderator, Jenny Alton from the New York Small Business Development Center Central Office. This webinar is brought to you by the PACE SBDC, a regional center of the NYSBDC. The NYSBDC is a U.S. Small Business Administration resource partner with regional centers at higher education institutions and outreach offices at other locations across New York State. Our free advising, education, research, and advocacy services are made possible by funding from the SBA, New York State, and our host campuses. We are working today in partnership with the New York State Society of CPAs. And from that society, we have with us today Ramona Cedeño, CPA and founder and CEO at FiBrick. So you know, we are recording today. We will share links to a PDF copy of the slides and the recording in a follow-up email. Attendees are muted and will not be on camera. We'll be having you put your questions in the Q&A box. If possible, we'll also be monitoring the chat. If you would like to open your Q&A box now, look for the Q&A button at the bottom of your Zoom window. And if you don't see it there, you can click on More and look for it in the options that appear there. We will address questions throughout the presentation. So with that, I will turn the time over to Greg.
Thank you, Jenny, and good afternoon, everybody. I'm Greg Callender, a business advisor with the Pace University Small Business Development Center. The Pace SBDC provides a wide variety of services, all free of charge, to both existing New York small businesses as well as to aspiring entrepreneurs who are looking to start a business. An example of some of the services we provide include helping entrepreneurs to obtain financing, assisting with comprehensive business plans and financial projections, developing social media and marketing strategies, applying for MWBE certification, and gathering market research. The PACE SBDC's one-on-one services are offered both in person and via Zoom. They are also offered both in English as well as in Spanish. In a few moments, I'm going to place into the chat two links. The first link is to the main PACE SBDC website, where you can learn more about all of the services that we offer. The second link will be a registration link where any one of the attendees can register for free to receive free one-on-one business assistance. In addition to the free one-on-one advisory services that we also offer a variety of training and educational programming. One of the common challenges that many small businesses face, keeping their financial records in good order. So because of that, we are very, very thankful to have Ms. Ramona Cedeño, a CPA and the CEO of the accounting firm FiBrick, to share her expertise with us on bookkeeping best practices. Also want to let you know that in addition to serving small business clients through FiBrick, Ms. Cedeño has provided valuable service to the small business community by, among other things, she's been a member of the advisory board of the New York State's SBDC program. So Ramona, thank you very much. Really appreciate your time today, and I'll turn everything over to you.
Thank you so much, Greg, and thank you, Jenny, for organizing this event. I'm so happy to be back. I always enjoy helping entrepreneurs organize their finances. I think that having everything in good order for your business and personal finances is key to success. And the more we gather and organize our financials, the better informed we are to make different decisions, like applying for a loan and applying to become MWB certified. So happy to be here, and I welcome the questions. I welcome the engagement through the chat, and Jenny will be so kind to let me know what's happening in the chat. And at the end, I hope we can have some time for questions too. So if you don't get to ask your question as I'm going through the slides, write them down and we can hopefully answer them. I will move on now, and Jenny and Greg both talked a little bit about me, but I'll tell you my version of Ramona. I love finance, I love numbers, I love money. I am not ashamed to say it, and I have been doing this for many, many years, even before being my own, being a business owner myself. And this is something that I have been so passionate about that I wake up every morning and I say, like, what spreadsheet am I going to look at today? Which app is going to tell me what's going on with my finances or my clients' finances? This is my life. And I also wrote a book called Simple Choices, Big Rewards in Money, where I talk about personal finance tips, how to increase our financial freedom or achieve that financial freedom that we all want. And I think that being a business owner gives us a lot of leverage there, because there is a lot of good planning that you can do, tax planning and just financial planning as a business owner that supports your personal financial goals. Connect with me on LinkedIn, Instagram, or any other platform that you love. And I answer all my texts, my messages personally. So I look forward to hearing from each of you at some point. So today we have an agenda that appears to be a little long, but I try to cover all of this without getting too much into the weeds, because each one of them has a lot of different ramifications, different components. My goal today is to bring awareness to some of the areas that business owners tend to neglect when it comes to financial reporting or bookkeeping. And I hope that after this event, you can go back to your offices or whatever you're working with your team, or individually if you're one solopreneur or just starting out, and start implementing some of these tips that I'm going to share with you. And once you get ready to hire an outsource bookkeeper or CFO, fractional CFO, or tax advisor, that whatever we're sharing here gives you that opportunity to have those conversations with those advisors, and also allows you to select the right advisor when that time comes. I will talk about the importance of bookkeeping, understanding your financial statements. What do they tell you? How to use them to make decisions in your business. Some of the best practices that that we recommend business owners to apply when it comes to bookkeeping. I have been a controller at larger firm. I have been a fractional CFO for many firms. And the way I want our clients and the small business community to handle bookkeeping and financial reporting is from the perspective of what would someone else do if they look at these financials and I want them to buy into my company or fund my company. I want you to think about, it's not just for me, it's for that outside stakeholder one day that's going to look at my books and make decisions based on that. So think of your company as a big firm at some point and manage the finances that way, and you'll be in good shape to secure funding or to bring in a partner or just to make decisions to grow. Another item that I have here is I want to share some tips on cash flow management, some strategies there. At the end of the day, if a business doesn't have cash, the chances of success are low, and bookkeeping is the foundation to determine how much cash I need, how much cash am I investing in the business, how much is coming in, how much is going out. But the bottom line is that we need cash, and managing that in an effective way is key to success. I'll mention a little bit about budgeting and forecasting. When we talk about bookkeeping, a lot of times we leave out the planning components of financial management. And to me, it's important to remind you that a budget or a forecast can be instrumental in business management success. I'll share some tips on KPIs, key performance indicators, what to look for when you're looking at those financials that will tell you if your business is healthy or not, or just needs some attention. And some tools that you can use to start managing the bookkeeping for your business in an automated way and efficiently. So that's a lot, right? I could have given you 3 tips, but this is trimmed down. I wanted to give you some tips on taxation and some tips on different things that we look for in our business. The importance of accurate bookkeeping is based on the fact that we want to ensure that our books are transparent, that the controls around costs are there, and that we are making decisions based on information that the data is telling us. This might sound like a lot of words and big words, but imagine that you're just starting your business next month and you're going to put in some of your own cash to invest in that business, to buy the first supplies and to invest in marketing. If you just take this money out of your bank account and you start spending it and you don't know where that is going, how much is going to marketing, how much is going to those supplies that I might need, how much am I paying to the teacher that I need to teach that class that my business is offering. If you don't track those things, in a few months, you are going to look back and say, I spent $10,000 and I don't know where it went. Or I spent $10,000 and I don't see what it's giving me in return. This is the reason why we need bookkeeping, is to really be able to measure how the business is doing in terms of revenue coming in, money is going out, investments that we're making, and how we're distributing it across the different expenses that we have for the business. As we organize the finances, we can then see what they're telling us and then how we move forward from there. You may have a business that is making $50,000 in a year or $50,000 a month. You're spending 80% of that and you're left with a certain amount. If you're not tracking that somewhere, you might think that you're making 20% profit, 10% profit because your bank account shows that you have about that. That's not the full story. The story comes in when you are actually tracking revenues in the right line of your P&L, profit and loss, income statement. It's all the same, P&L, profit and loss, income statement. When you're tracking the sales in the right buckets, each of the expenses in the right bucket, you will be able to see where you're overspending, where you need to invest a little more. Are you making a profit or are you losing money? Bookkeeping can be done in QuickBooks Online. We love QuickBooks Online just because it's easy to use. There are pros and cons. There are different opinions about it, but QuickBooks Online is good. There is one called Wave Apps. It's free if you're doing your own bookkeeping. And then you have Xero, Xero is another one that's available for this type of processes. You can also do your own bookkeeping in Excel initially, if it is a low volume. If your company is low volume, initially you have 3 customers and they're paying a large amount of revenue to you, and you have a few expenses because most of your cost is concentrated in a couple of items that you have to invest in. This is very common for therapists. They don't have a lot of overhead. Most of what they spend is on a few software. So it's easier for them to do their own bookkeeping. But if you have a manufacturing company or an e-commerce where you have tons of different types of expenses, an application for the bookkeeping is best. Some of the benefits, as I mentioned, it helps you with being ready for compliance with tax filings, being ready to apply for a loan, ready to apply for that minority-owned business certification, because they are going to ask you for financial statements and they're going to ask you sometimes for maybe projections or samples of a few expenses or invoices. Greg mentioned the business plan and the loan readiness that they support you with. The business plan, part of that, initially, if you don't have a business, you'll be projecting everything. But some business owners come in to do their business plan after they have been in operations for a little bit. So knowing what the business has done as of that point will help you put together that business plan also. And for loans, you will definitely have to provide some sort of P&L or income statements, and sometimes the balance sheet. I will go to the next slide, but if there are any questions so far, please let me know, Jenny, and I'll pause for a second.
We just had someone who wanted to have you repeat those names of the other softwares besides QuickBooks.
Oh, yes, if you can, maybe you can help put him in the chat, but it's Xero is with the X at the beginning, Xero. And the other one, and Xero is not free. is a competition or competitor to QuickBooks. And the one that's free is Wave. Wave Apps is WAVE apps. And it's called Wave, but their website is waveapps.com, I think. Thank you.
Yes. And I will drop some links for those into the chat. Also, we have somebody who wanted to know, she says she's been in business for 2 years and is terrible at bookkeeping. Is it too late? How do you begin? if you didn't start out this way, but now want to.
Yes, that's a good question. And it fits into this. When I have a client that comes to me with that, I ask them, how did you prepare your financial statement, your tax return for those 2 years? She doesn't have to answer this right now. And it's not a judgment. It's more like that can be the foundation for starting bookkeeping. If you have some type of income statement or summary of revenue and expenses that you use for the business tax returns, those 2 years, that means that there was something put together, even though you might not have it on paper right now. Maybe your tax accountant did it. Maybe you did it when you were doing your own tax return. You put together your summary of revenue and expenses. So that would be the foundation to say, okay, let's start clean now with the transactions for at least this year. So if you're doing this today, I would say connect Wave or implement QuickBooks, and you connect your bank account, business bank account. We're going to talk about that, the separation of business and personal bank accounts. You connect your business bank account to one of those applications, and you say to the system when you're connecting it, give me all the transactions from January 1, 2024 onward only, because if you had to go back 2 years before, that would be a lot of work. You can do it if the bank allows you to connect historical data going back as far as 2022 to the bookkeeping tool. You can do it, but you have to classify all of those transactions manually or creating some rules. And sometimes it's not necessary to go back so many years if you have something that supports your tax return. If you do end up going back 2 years and organizing everything from those 2 years, at the end, you would want to know that what you came up with, which is your profit and loss, aligns with what you reported in your tax return. And because if they're different, then that can create some confusion for you. Like, did I report everything? Did I overstate something? So hopefully you end up with the same numbers. And if you don't, you can do a little research to see like what was off. But just to summarize, you can start just from the current year onward and use your tax report as support for the prior years. Or you can go back, and if you organize everything going back, I would suggest reconciling back to the tax return. We do that for all of our clients that come with the same issue. We want to make sure everything is in good order. That's a good question. Anything else, Jenny?
So you may be going to cover this, but what statements need to be provided to a tax accountant for tax prep?
Good question too. So that, if you have an accounting tool, a bookkeeping tool, or even if you have organized it in Excel, your accountant is going to ask for that profit and loss statement. And it might be called something else. They might say, oh, send me your summary of revenue and expenses. Send me your income statement, send me your P&L. That is this one. And that report includes the total revenue that the company has generated in the year and all the expenses summarized by expense type. You have marketing, insurance, compensation if you have employees. If you're doing this in a bookkeeping tool, the system is going to generate this for you if you're doing this on a monthly basis, or even if you do it at the end of the year, which is not recommended by us because you want to do bookkeeping monthly at least. But if you're using an accounting tool, this profit and loss is generated by that tool as you post all the transactions that are coming from the bank feed. And if you're doing this in Excel, you're going to download all your bank data for your business account, and you're going to categorize them into revenue and expenses by type. The tricky thing with doing it in Excel is that, it has to be summarized. So you may have, if you're not good in Excel, it's better that you do it every month when you add, like, this month I made 10,000 in revenue and I spent $500 in marketing. It has to agree, whatever you add every month to your Excel file has to agree to what's going through the bank. The tax accountant may also ask you for your bank statements, and just so that they can validate some transactions. Depending on your entity type, if you have a C Corp or an S Corp, the tax return requires, in a lot of cases, that you include a balance sheet. So if you are an S Corp or a C Corp that's generating a significant amount of transactions, I would say you should be in a bookkeeping tool that's going to generate the balance sheet too, because the balance sheet is really hard to do manually. And a balance sheet tracks the assets and the liabilities that the company has. It will have the cash in the bank, accounts receivable, if customers owe you money. It's going to have loans that the company owes or has outstanding, and also your equity. And the equity is monies that you have contributed, less monies that you have taken out of the business, and so on. And I know that was a lot, but I just covered the whole slide, Jenny, with that question.
Well, that was perfect. And so I know we have some people who are just starting out with us today. So if you have minimal income, right, just starting out, is there a pared down list that you would typically take to your tax accountant, or would that be different in any way?
The summary of revenue and expenses applies to every business. I think what will be pared down in this case is the type of expenses. You may not need to have insurance. So you're only going to summarize the expenses that the business actually has. Nothing is going to be made up, right? So revenue is going to be total revenue, and it's one line. And then the expenses is where you need a breakdown. And if you only have 3 types of expenses, you're only going to list 3 types of expenses. And the types would be, I gave a few examples, but it could also be credit card processing fees. It might be software, but you don't have to list all types of software. It's like one category that includes your DocuSign, your MailChimp, all of that into one summary.
Okay. We have one
Great.
more question.
Oh, yes,
if we
yes.
may.
Mhm.
So can expenses incurred before a legal entity is set up, for example, training that had to happen, or workplace Zoom, etc., but was in the same year as when the business was established, do those count toward taxes or no? How would that work?
Yes. So that those are considered startup costs. There is formation, there's organizational costs and startup costs, and both are eligible for tax deduction once the business is set up or registered. Now, the distinction is that some of the costs will be deductible as soon as the business is established, and others will have to be deductible or expense over a period of a few years. You will need it to work with your tax accountant for that. But I would suggest tracking all these costs before the organization is actually registered with the state. And the difference between the two, the startup and the organizational cost, it depends on the type of expense. If you're paying a lawyer to advise you on what entity to set up, that will be an organizational cost. If you are buying a computer to start the business, that will be a startup cost. The accountant will help you organize them, or you can do some research if you're doing your own books. But at least list them by type, and then when you get to the tax return, you would know how to treat them. If these amounts are large, I definitely recommend working with a tax advisor, because the capitalization and amortization, which means the money that needs to be spread over a few years, it's important to categorize that properly in the return, and then the depreciation, amortization is important to do it right also, so you don't get into an audit situation. But good question.
Excellent. Yes, and I just want to note very quickly, you're giving out fantastic information to our attendees today. We've had several questions about, are we going to get the recording? Yes, you will. You'll get the recording and a link to it, and a link to a PDF copy of the slides in a follow-up email. So you can look for that in your inbox. We definitely want you to be able to refer back to all of the fantastic information Ramona is sharing today. All right, Ramona, carry on.
Thank you, thank you. The cash flow statement is a summary of the monies that went out of the business and the monies that came in a given month. It sounds like similar to the profit and loss if you are just managing your profits based on cash in and cash out. Your P&L. If you're managing your P&L, your profit and loss in just on a cash basis, which means money's in and money's out, this sounds like the cash flow and the P&L will be the same. However, the cash flow also takes into account monies that come from non-P&L items, like if you borrow from a bank, or if you paid off a debt, that will show up in your cash flow. This is truly like, how much money do we have from the monies that came in and the monies that went out, regardless of where the money came from. It's not something easily available if you're doing this manually. You would have to, you can track it, but it's not going to be a perfect cash flow statement. The cash flow statement is usually prepared by the bookkeeping tool. And I don't know if you can see this, but I'll move it. Can you hear me, Jenny?
I can hear you. It's freezing up a little bit here and there, at least on my screen. But okay, yes, now we can see the profit and loss and the balance sheet.
Okay, okay, I think you went a little too far. Okay, great. This is an example of how the profit and loss looks. This is not going to be the same for everyone. It's not going to look exactly the same for everyone, but it's a good picture of how at the end, once you organize your revenues and expenses, how it might look. Different line items depending on your business. For example, the revenues, you see revenues here of 100 and cost of goods sold of 50. This means that this is a company that maybe is selling products and they generated $100 in products, and the cost of creating those products was $50. Then we have operating costs here. This will be the rent and the salary. This is a summary, but you would expand this into multiple categories if you're doing this in Excel or in QuickBooks. This is a very condensed version, so we can fit it here, but it will look something close to this when you do it. The balance sheet is going to show you the balances in cash, accounts receivables. This is the invoices that you have sent out to your customers, but have not been paid yet to you. If you have inventory, the balance sheet shows that. So this is all assets that the company owns will be in this asset section. And then under liabilities, you have the debt that you have outstanding, accounts payable. If you owe monies to your suppliers, it would be here, assuming you have entered those bills in your accounting tool. If you just pay them, if you just pay the bills as you receive them, nothing will be here. And then the equity section shows how much you have accumulated in equity in your company, contributions that you have made and monies that you have taken out. And then the retained earnings is the accumulation of net income that the company has generated. Any questions on those two?
I think we're good to carry on right now.
Okay, great.
Thank you.
The statement of cash flow, I mentioned that before when I was in the summary before the intro page. And this is all the cash in and out that flow through the company. And this is a summary of the cash that came from the operations of the business, all the net income, which is all the monies in from sales minus the expenses. That would be here. Depreciation and amortization. If you have assets, you will need an accountant to help you with this portion. So this is a little more, this cash flow statement is viewed when you're growing and you already have someone that's managing your bookkeeping, like your someone in-house or your CPA or bookkeeper. I'm bringing this one up because there has been a lot of talk recently around, is your accountant giving you a statement of cash flow? And a lot of times this is overlooked, but when it's detailed properly, it gives you a lot of information. Again, this is a little condensed, but each one of this would be expanded if you were doing this in QuickBooks or Wave or Zero. Okay. I'm not sure if I went too far, Jenny. I think we're having a little bit of technical issues. Do you see that?
Yes. Yes. We see essential bookkeeping right now.
Okay.
Is that what, and we do have a couple of questions when you do want to take those, just so you know.
Okay, yes, let's go with the questions.
Okay. So, someone asked the example Excel docs.
Mm-hmm.
Do you have those anywhere that people can access?
I can share with you a template that we use for our tax clients that don't use a bookkeeping tool, and my brain is thinking because we have a few different templates, and I'm like, which one would be best? But we have clients that don't use bookkeeping tool, and they're tax preparer, and we send them a template where they put the data. I can share that one, and then there is another one that I use in some of my webinars. So I send both, and then see, the participants can pick the one they feel more comfortable with.
Fantastic.
Great.
Does getting proper licensing count towards startup costs?
Is this a license that's essential for the business? And we don't have to answer that, but if the licensing is essential for the business, then yes, it would be considered either one, an organizational or startup cost. I would say maybe it'll fall more under startup costs because it's not to set up the business, but to operate the business.
Understood. Then we do have one more question. For the balance sheet and cash flow statements, are they created initially from the profit and loss inputs if using an online tool, and then you go in and add additional items as needed? Is that how that works, or can you clarify?
That's a great question. So in accounting, every entry, every number that you enter in any tool or in Excel has two sides. So let's say you spend $10 in marketing. That goes $10 going out in marketing expense in your P&L, and the other $10 decrease your cash on the balance sheet. So anytime you're doing something in the accounting tool, the system is automatically adding or subtracting from both the P&L and the balance sheet. This is why if you're doing this manually, it's really difficult to do this and keep up with the balance sheet, because we tend to just enter in the P&L. I spent $10, I got $10. And then, okay, but the balance sheet is not being updated. It's really hard to do this in Excel. The cash flow is a function of those two statements, the P&L and the balance sheet, that also gets generated automatically. You don't have to touch it. There might be a type of expense, a type of purchase that you make that only goes to the balance sheet. And an example of that would be if you buy a large piece of equipment that is an asset. It cannot be expensed right away because there are rules around what can be expensed right away when it's a large asset. Like if you buy a car, for the business, you're not just going to spend that. There is a lot of mechanics that have to go into it to determine when it can be moved to the P&L. That's a tax issue for your tax advisor. But when you first record this in QuickBooks or in whatever tool during bookkeeping, you would book this as a fixed asset on your balance sheet. The other side of that also goes on the balance sheet because it's either cash, if you bought it in cash, or a loan to the financing company. So by doing these entries in QuickBooks, by categorizing the transactions that are going out of your bank in QuickBooks and knowing where to put them in the P&L or the balance sheet, the system will know where to put the other side. That's for P&L and balance sheet. And the cash flow is automatic.
Fantastic. Please carry on because I want to make sure you get through all of your material.
Yes, yes. Let me see if I have anything. Okay, great. So I wanted to go back to the last one to make sure I didn't skip anything. These are some essentials of bookkeeping: separating personal and business finances, separate bank accounts. I do not want to hear that I don't have a form of an official business, that I'm not registered, I'm a sole proprietor. No, if you're running any type of business, have a separate bank account. If you need a credit card for the business and the credit card cannot be under the business name because the business doesn't have credit, most businesses can get a credit card under their name, but some of you can't for whatever reason, and you want to use the personal account to run some expenses for the business, dedicate that credit card to the business and do not put anything personal there. And then until you can create or open a business credit card. By doing this, when you connect those business accounts to your accounting tool, those expenses are gonna go, you're gonna know that as you classify those expenses and that income is only for the business, and there is no this confusion of, did I include everything that I need to include in my tax return? You're not gonna have that doubt. Did I overstate something because I was paying my rent with my business account? Just have a separate business account and only use it for business expenses. And if you ever need to fund your business with personal funds, what you do is you make a transfer from your personal account to your business account, and you spend the money from there. And the same occurs if you need to take money out of the business for personal purposes. You will make a transfer to your personal account and pay your rent from your personal account. That way, the business account is clean. Those transfers are treated as distributions or loans between the owner and the company. That's a little bit of a tax issue there, but for bookkeeping purposes, you will classify owner's draw as owner's draws. There is an account called that in QuickBooks, or you can create it. And the same thing, if you are contributing, there is a owner's contributions account. It might have different names. It could be owner's investments, or owner's distributions. And that's how you separate those transactions. Reconcile your accounts timely, at least once a month. And when you are doing this through QuickBooks, and I'm only using QuickBooks, but that implies any other accounting tool, the system is going to generate the cash balance based on the ins and outs of the transactions that you have posted throughout the month. And the cash balance that QuickBooks is going to show on the balance sheet should agree to your bank statement balance. And if it doesn't, that's when you start to research, what did I miss? If you're doing this manually, again, I'm not gonna, it's gonna be hard to do that manually, but you would have to figure out a process to do that. What you want to see is that everything that, if you're doing this manually, everything that I have added to my profit and loss statement throughout the month in Excel, how do I feel 100% confident that that's what went through the bank? Because we make mistakes when we are adding things manually. We forget one transaction. We thought we entered it, but we didn't. So you have to come up with a process to reconcile the two. And most banks show you a summary of like total receipts and total disbursements. You can create something like that in the Excel file that shows total receipts and total expenses, and then you compare that to the bank statement. That would be only comparing the activity throughout the month. For the cumulative balance, you have to do a little more work on the Excel file to make sure that you have a running balance of transactions. Tracking your business expenses, which is the third item here, is if you have a separate business account, this is a piece of cake. If you have commingling of transactions, then go the extra mile to try to figure out, what did I pay from my credit card, my personal account that is related to the business, and track that also in your spreadsheet or enter in the system that you're using. There is a way to add transactions manually that came from other sources. That's a little more advanced. You can, let's say you have a bank account for the business, it's connected to QuickBooks, but you did have an expense from your personal account. Just track that separately if you don't know how to enter in QuickBooks. And then at the end of the year, you can tell your accountant, oh, I also have these additional expenses that I pay for personally. Can you please enter them in QuickBooks for me or report them in my tax return. Any questions, Jenny?
Yes.
Of course, right? I love this. No, I love that we have
Yes,
very
absolutely.
engaged audience.
So we do have an attendee who is looking at a particular type of checking banking, in this instance, American Express. And so are there types of accounts, certain institutions that you've seen your clients have success with? Do you have any, any off the top of your head, that these are ones that in your experience you've seen go well for your clients?
Bank accounts for checking, is that?
Yes. Yes.
Okay. What is popular? And we might not love all of them, right? So I'm not endorsing a particular one, but what is popular among my clients are Chase, Bank of America, and Wells Fargo is what I see are the most popular ones. Some of the tech startups use other types of banks, more newer banks, Brex. We all heard what happened with what is it? Silicon Valley Bank, SVB. We know what happened with that. There is Valley Bank that are also around. I have seen First Republic, at least one or two of my clients use them. And TD, some clients tried them, but then the reporting system, the reporting features are not as great, up to date. Like they don't give you bank statements or data. I'm just throwing a number. Older than 6 months, for example. So you have to look for those things like how long can I pull data, the connection with QuickBooks, the usability. Of course, an SBDC, you may have more information on this. Which ones of these banks are going to be more small business friendly when it comes to a loan or a line of credit? I personally have a situation where I use a different bank for my line of credit than I use for my day-to-day operations. And I have lines of credits with Amex. They're really good with their small business credit cards and line of credits, but I haven't tried them for operating checking accounts yet. Chase is good with their business account, credit card and the points that they give. So you might have a bank that's really good operationally, like from the features perspective for the checking account, but not as friendly when it comes to giving you a line of credit or a loan. So you do need to make that assessment before you make those decisions.
Ramona,
Yes,
Jenny,
Greg.
I'd just like to add on to Ramona's comments. I really think it depends on the individual small business owner's situation. Yeah, generally speaking, the larger banks, the Chases, the Cities, the Bank of Americas, they have a full suite of banking services, but they tend to be the most expensive in terms of monthly fees or minimum balances required and so forth. So for many small businesses, credit unions may suffice, or some of the smaller banks in your neighborhood. It depends on what type of banking your business is going to do. Are you going to have a whole lot of cash? If you have a whole lot of cash, you don't want to have to go 20 blocks carrying a bag of cash to make a deposit. So then you might want to consider banks that have a branch that's pretty close to where you're doing business, say like a home-based business. So it's really going to vary from situation to situation. Another thing to take into consideration is if you already have a strong relationship personally with a bank, you may get a break on your business banking, fees, et cetera, by combining all of your banking under the one roof.
Good points. Yes, thank you, Greg, for that.
Yes, thank you. And we have a couple of questions relating to credit history. And so do some banks then require a business credit history in order to get a credit card? So like you have to have been in business for a while then? I'm thinking this person is saying.
Yes. For credit cards, it's easier, I think, to get a credit card from the beginning because a lot of banks will say that they're giving you a credit card for your business, but it's really your personal credit. So your name will show up on the card and your business name will show up on the card. So that means in most cases, you're guaranteeing the credit. So your credit is what's going to be backing that credit card. And so if you have good credit, they're not going to reject that application for the business because it's on your credit. When it comes to having the credit card under the business name, my guess, I don't know the answer to this, is that the business will have to have some history there. But you know, if any of you have more on that, I am talking from experience because I started my business. When I started my business, I got my first credit card, and I have gotten a second one. And I see credit cards that have my name, and then others that later on it was just a business.
Right. That makes sense.
Yes.
So if money is drawn from a business account to a personal account, then is that money taxed? And then if that money is eventually returned to the business account, how does the tax work then? Because I know you talked about like a loan or
Yes.
as such. What are some of the details around those situations?
I love how this, you know, we're sneaking in the tax, not you, but like, I love how this all like automatically, I feel like we're here, like we're family already. I don't know, the audience, like, give me your comments. I feel like I know all of you. But I do, that is great that I'm getting the tax questions without having the tax line. But when you have a single member LLC or a partnership or an S Corp, and you take monies from the business, that is not an expense. If you take a distribution, it's not an expense to the business. And if you put money in, it's not income to the business. Those activities are recorded on the balance sheet. So you contribute 10, and if you don't have a balance sheet, then it's like they're nowhere, right? But at some point, when you need that balance sheet, someone is going to ask you to recreate the history of movement of cash that happened with your business. So let's say you give the company $10,000, that's the contribution. Most CPAs would say, let's not call it a loan, let's not call it right. I mentioned that because in some instances we might say it's a loan, depending on, let's say it's a partnership, you have a partner, you want your money back. You're just lending the company 10,000 because you want it back 2 months later, right? But if you're the only owner, you're contributing the money to the company, you can take it back anytime. If you contribute this 10,000, it goes to the balance sheet under contributions. If you take it out in 2 months, it comes out of distributions, all on the balance sheet. Doesn't hit the P&L. The company pays taxes, a single member LLC or an S Corp or a partnership, all three are the same, almost for these purposes. They all pay taxes based on the income, the net income they generate, regardless of distributions or not. If you don't take a penny and the company made $100,000, you're paying taxes on $100,000, and that tax is paid at the personal level. If you make $100,000 and you distribute to yourself $100,000 in the same year, you still pay taxes on the $100,000. So that's how that is treated for tax purposes. I hope that answers the question.
That was a fantastic answer. And in the interest of time, because I know you have a hard stop at 1 o'clock, so let's carry on. We'll hold other questions and see what we can get to.
Yes. And of course, I love to have to leave you all because I really enjoy these conversations, but I'm at a conference and I want to go attend a few more sessions today. Cash flow management, these are tips to ensure that you have cash in your business. Well, you're going to say, but what if I'm not making money? How can I guarantee that I have cash? No, but cash flow management can improve the chances of having that cash handy when an emergency comes up. Timely billing and collections from your clients and your customers. If you're invoicing your customers at the end of the month or even at the beginning of the month, if you're getting prepaid for the month, be consistent with the timing of your bills, have the terms on your agreement, and follow up with your clients if they don't pay you within 5 to 10 days. Because if you get a little lax with the process, the clients are not going to take the term seriously, right? So if you say we demand payment on receipt of the invoice, and then you do that, you collect 1 month, you enforce that, and the next month you let it go, and there is inconsistency. People read into that, right? Like if you're on the other side, you're like, oh yeah, they're fine. They don't really need my money. Sometimes I pay them late and nothing happens. So to ensure that the behavior supports your business goals, you have to enforce it, and you figure out how. Direct debit, if that's an option, where they authorize you to take the money out of the bank account on the day the invoice is due. Following up, having someone on your team that does the follow-ups, and just having conversations with your clients and saying, like, you know, these are our terms, and we notice that there is a lot of delay with the payment. Is there there something going on that we should be aware of? Just make sure that you are on top of it. Being ready for the second item here is being ready for that credit card, that line of credit, and that business loan. Having good credit at the personal level. Most small business loans are guaranteed at the personal level. So your credit is important. Your own credit history and your credit score. And of course, as your business borrows, ensuring that the business pays on time so that both you and the business have good credit history. This is going to be critical when you are applying for a line of credit or a loan and a credit card. A line of credit, I always suggest that if you're generating revenue, I would say once you reach $100,000, $200,000, and it could be before it depends on the bank. But once you reach a certain amount of revenue, apply for a line of credit so that you have it as backup in case you ever need to use it. The way the line of credit works is that you pay a small annual fee, $200, $300 per year, just to have it, and you only pay interest if you borrow from it. Still look into the interest rate that they would assess, look into how much available credit you have. And if you do get one, I would say to, like, maybe borrow a little bit from it, $1,000, and pay it back if you can, or $5,000 and pay it back soon. That way you keep it open. If you don't need it, don't use it more than just that. The emergency fund, we always talk about this and recommend it at the personal level and the business level. This is where you're setting aside enough funds to cover 3 to 6 months of operating expenses. At the personal level, we say, 6 months of what your personal expenses are. That way, if there is a downturn in the economy, we can sustain some of those expenses that we cannot get rid of right away. You don't want to fire your staff the minute that you lost a big client, because you might get another client in 2 months. So if you want to keep those valuable team members during that time where the business is not doing so well, your emergency fund will be covering that temporarily. And maybe your line of credit, if you're confident that you can get the new client to replace the one that left. 3 to 6 months is not enough. In some cases, you'll see professionals recommending 12 months and 18 months. 3 to 6 months is still risky, but there is also a lot of times we hear that, how can I save more? But you aim for the highest possible. And now that you have a great interest rate, hopefully in some ways it's good, in some ways it's bad, but as long as you have this high interest rate on the savings account, you can put the excess cash into a money market account that's giving you a good interest. Let's see, I don't think we have a lot more, and then we can get a couple of questions. Budgeting and forecasting, they're almost the same. Well, they're not almost the same. They're sort of similar purposes. Budgeting is when you create your budget for the next year, sometimes 3 years. So the next 12 months is like, it's more, I wouldn't say it's more detail and it's closer. So you have a lot more information. Some businesses have a budget that goes out 3 years, but the second year and the third year are more for guidance and for something to like work towards, but the focus is on the next 12 months. And this is usually a static budget for the next 12 months where you say, okay, we expect to get $100,000 and in revenue, and we're going to spend $80,000 in all of these expenses. And the drivers of that, the reason we're going to get the $100,000 is that we're going to get 5 new clients from these sources, right? So there is a lot of thought process that goes into it. The forecasting is when you actually are updating based on new information that you're gathering about your business or the economy. So this budget that says that you're going to get $100,000 is there. Now you come in, December comes in and you get a new client. you create a forecast where you start with your budget, maybe, and then you say, okay, I said it was going to be $100,000, but now that I have this client, there's going to be another 20,000. It's 120. You put that together in your forecast. So the forecast is it's kind of more flexible. You update it every 3 months or every month, and you're incorporating new information that you're getting. But similar files, similar summaries, and this is similar to your P&L, your profit and loss, but we just have reasoning behind the numbers. Things to look at in your business is how your company is growing, how your revenue is growing. So we want to measure growth on a monthly basis and quarterly basis. You want to see how your expenses relate to your revenue, the proportion. This is what the expense ratio is, the proportion of your expenses over revenue. And this is like certain expenses. If you're spending more than 5% in marketing, for example, that means that you're probably overspending 5% of revenue in marketing. If you have payroll and your payroll is 50% of your revenue, what does that mean for your business? Can the rest of the revenue support all the other expenses that you're going to have in the business? That is key to measure these things. And this is a little more, I mean, it sounds like advanced, but at the same time, it's like, if you knew this at the beginning, you'll probably be able to make better decisions. So it's, a lot of business owners don't learn about this until it's a few years later. But I would like for you to learn about key performance indicators and see like which ones you would like to track for your business. Gross profit margin is important if you have a business that produces a service or product where there are direct costs that you need to generate in order to produce that service or that product. So for example, I always use this as an example. If you have a school that you teach after school programs or whatever other language school, and you need teachers to teach the classes, if you're generating $100,000 in revenue from those classes, but you're paying your staff $80,000, that means your gross profit margin is only 20%. That might be too low to support your overhead, your operating expenses, the marketing, the rent, everything else. So that's what that measures. And the net profit is the bottom line. We want our bottom line to be positive and to be as high as it can be. There are industry benchmarks. So if depending on your industry, you might be able to find out what is the average net profit margin for an e-commerce. What is the net profit margin for a tutoring school? You can look that information up online. And if you are way off, if you're ahead, then happy, it's great. But if you're way under that, understand by looking at your expenses and your pricing and your just number of clients that you have, reviewing that carefully to see where the gap is and how you can improve it. That's how we were talking about having a P&L that shows you how the business is doing is going to help you make assessments on how the expenses are trending and how the revenue is going. Maybe your pricing needs to be revisited. Maybe you have a client that's absorbing too much resources and it might not be the client that you want to keep. Any questions, Jenny?
Yes. So we are at 1 minute. So we'll try and get 2 lightning questions. First of all, can you give your accountant access to your online bookkeeping tools, and is that recommended?
Yes, and I'll give you a couple more minutes. Okay, this is what I always do.
Oh. Okay.
I get myself in trouble. Don't worry now, don't worry. So it's a great question, because if you're starting with QBO, QuickBooks Online, or any other tool that pays, talk to your bookkeeper or your tax accountant, because we get a wholesale price that we sometimes pass on to our clients. I always pass it to our clients. So it's good if you're going to start with one of those tools for the first time and you already have like a CPA that's a QuickBooks partner, they can get you a discount. So at that point, they will own the account. You'll be the admin. Whenever you leave them, they can easily transfer the ownership to you. You don't have to start from scratch. And by default, they're going to have access to QuickBooks and you're going to have access. If you already have QuickBooks, yes, you can add or 0, you can add your accountant to the tool. There is an option to add an accounting firm or to add an advisor. You probably have 2 that you can add. So yes, the answer is yes, but I wanted to give you a little more so you know about the discounts.
Wonderful. We've had a couple of questions regarding templates. And so I know you'd said that you were going to share some templates. Trying to remember what you said.
Yes, I will, income statement templates, I will share some.
Okay. Okay. Yeah, we do have some people asking about, let's see, balance sheet and invoice. So, I mean, if you have any recommendations on places to find good ones as well, we can include that in a follow-up email. So, okay. So we've talked about these tools, these online tools. So budgeting and forecasting, do these tools allow you to do budgeting and forecasting as well? Or is there some other online tool that you would use for those functions?
This is the one time when I'm going to say Excel is really the amazing tool for budgeting. And we do have a template for that. So let's touch base offline, Jenny, and we can send you the templates and you can share them. What
Wonderful.
those tools do have, QuickBooks, for example, is that once you have your budget in Excel, you can enter it in summary, at a summary level in QuickBooks, and you can run reports of budget versus actuals. You can see where your budget was and what your actuals are once you do the bookkeeping. There are other tools that are used for budgeting, a little more complex, but they exist and it can be a great replacement of Excel if Excel is becoming too much.
Understood. So we touched on this some before, but just to kind of narrow down specifically on this, we have someone, a new business owner and no employees. So the best way tax-wise to pay themselves from the company is what? Because we talked about moving money back and forth, but just to clarify this point.
If they are a single member LLC or partnership, they cannot be on payroll. So they must just draw monies from the company as distributions. That's the only way, and that's the best practice way. So they don't have to set a salary. It could be whatever amount, as long as the company has made the money, they can take it out anytime, and that's their money. The net profits of the company is still taxable to them. It is as if the net profit is their salary, and whether they take it out of the company or not, it doesn't matter. That's their taxable income. If you're an S Corp, you must be on payroll through a payroll system as an employee, and you set your salary based on some standards that the IRS prescribes. So it's something that you need to look into. But let's say you have an S Corp and the S Corp makes $100,000 in profits before your salary, you might be able to set your salary at $60,000. The remaining is still your money, and then you can draw that as distributions, just like an LLC.
Wonderful. And I want to be respectful of your time, so we'll do one last question here. And Greg, you may want to chime in on this one. So we have somebody who's looking for a tax professional to partner with on due diligence for a new business acquisition. And so suggestions on how to go about finding someone for that.
Sure, I'll jump in. In addition to obviously considering Ramona, who is outstanding, what I can do is I can send you a list. I can send anyone who's interested a list to some of our previous webinar recordings. We've been very fortunate to have other members of the New York Society of CPAs present to us on a variety of topics. So I can send anyone a link to the webinars where they can view all of the previous presenters, including Ramona, who again is fantastic, and that would be up to the viewer to decide if they wanted to reach out to one of the CPAs for a fee-for-service arrangement.
Thank you, Greg.
Wonderful.
I appreciate the feedback.
Yeah. So Greg, if you want to drop that email for the PACE SBDC into the chat one more time for anybody who wants to get in touch and get some further information from you and your colleagues there, that would be fantastic. And okay, so that's the website, and you can contact through there, get in touch with the PACE SBDC. Ramona, Thank you. This has been fantastic today. So much information, so valuable. And especially while you're at a conference, we really appreciate you coming and helping our audience today and taking your time. Just again, thank you. And thank you to all of our attendees. You've been asking fantastic questions, and we appreciate you being here and being a part of this experience with us today. We will have a survey that will show up when I shut down the webinar, and we would love to get some feedback on today's session, what helped you, other things that you would like to see trainings on from the PACE SBDC. It's always helpful to hear from our attendees. And so with that, Greg and Ramona, any parting words for our attendees today?
I just want to say thank you for all the engagement. I love it, love it. It makes this more rewarding. And thank you, Jenny and Greg. And I look forward to the next session at some point next year.
Indeed.
Yeah, I just want to say thank you, Ramona, for sharing your expertise with our attendees. Fabulous. Jenny, thank you for running the show, always making sure that everything goes smoothly. And thank you to all the attendees. Really appreciate you joining us today. And again, I would encourage you to visit us at our website, www.pacesbdc.org.
Fantastic. Have a lovely rest of your day, everyone. And Ramona, enjoy that conference.
Thank you.
Bye-bye, all.
Bye.